Okay, so our next part looks at the direct labor budget. So our direct labor budget is going to show the budgeted costs for the direct labor that we need to have to decide what the estimated production for the period. So to develop a direct labor budget, companies have to have the following things. First, they need to know the number of units to produce. That comes from the production budget. Next, they need to know the labor requirements per unit, the direct labor hours for each unit of the finished product. And then finally, they need to know the cost per direct labor hour. So here we see that 15 minutes, a quarter of an hour, of labor time is required to produce one unit. The labor is paid at a rate of $12 per hour. So if we look, we're going to include the number of units to be produced from the production budget. For October, it was 710 units are planned to be produced. We're going to compute the budgeted direct labor hours by multiplying the budgeted production level for each month by 1/4 of an hour. And then we can compute the total cost of direct labor by multiplying budgeted labor hours by the labor rate of $12 per hour. All right, next we're going to look at the factory overhead budget. So it's going to show the budgeted cost for factory overhead that we need to complete the estimated production for the period. So for this one, Toronto Sticks Company's factory overhead budget is up here, and they actually have separate variable and fixed overhead costs in their overhead budget, like most companies do. The variable portion of factory overhead using the predetermined overhead rate of $2.50 per unit of production, and their fixed overhead is going to stay constant, and it's going to be $1,500 per month. A lot of times we can also see other common budget costs like our supervisor salaries. We might see indirect materials, indirect labor, utilities, and maintenance and things like that. And we don't get into that too much. It's actually covered in Chapter 23, which we don't cover. All right, next we want to look at the production cost per unit. So for Toronto Sticks Company, we can compute the product cost per unit from the three manufacturing budgets: the direct materials budget, direct labor budget, and the factory overhead budget. So here we can look here, we see that it tells us for budgeting purposes, TSC assumes it will normally produce 3,000 units of product each quarter, giving a fixed overhead of $150 per unit. That's calculated by taking 4,500 total divided by 3,000 units. The other product costs are all variable. And this just kind of summarizes the product cost per unit calculation for us. All right, next we have our cost of goods sold budget. The product cost per unit is used to prepare the cost of goods sold budget and the budgeted income statement. So we can see here we have both. The cost of goods sold budget gives us the cost for the period. We have our budgeted income statement, which summarizes the expected income from our budgeted activities. Next, we need to look at the selling expense budget. So we look at that. It's going to tell us the amount of selling expenses expected during the budgeted period. So we might be looking at budgeted selling expenses based on the sales budget plus a fixed amount for sales manager salaries could be an example. We're going to use a sales budget to prepare a selling expense budget for Toronto Sticks Company. Sales commissions are going to be variable based on 10% of sales revenue. The sales manager salary is a fixed expense of $2,000. Sometimes other common expenses that we might see include advertising, delivery expenses, and marketing expenses. So here's the selling expense budget for Toronto Sticks Company. We are going to be looking at, again, they pay a sales commission equal to 10% of total sales, and they have a fixed salary of $2,000 for their sales manager. That's going to be added to get the total selling expense for each month. All right, next we have a general and administrative expense budget. So it's going to plan our predicted operating expenses that are not included in selling expenses or manufacturing budget. So it tells us here that Toronto 6 Company has general and administrative salaries of $54,000 per year or $4,500 per month. So now we're going to do the general and administrative expense budget for Toronto 6 Company. For this company, we're going to see a general and administrative expense budget that has $4,500 per month, and it's going to stay the same because it's a fixed amount. It's a fixed expense. All right, next we have our capital expenditures budget. It's going to show the dollar amounts estimated to be spent to purchase additional plant assets and how much we expect to receive from getting rid of plant assets. So it tells us for Toronto 6 Company, they do not anticipate disposal of any plant assets through December 2019, but they are planning to acquire additional equipment for $25,000 cash in December of 19. So since that's the only expenditure of the quarter, we don't have a separate budget that we're going to do. That's the only one that they have. In that case, we will incorporate it into the cash budget. All right, so let's look at a cash budget. All right. So our cash budget is going to show expected inflows and outflows during our budget period for cash. We have to remember that managing cash is very important for any company to be successful. Most companies are going to set an amount of cash that they require to do their day-to-day operations. So the cash budget is important because it helps that company meet their cash balance goal that they set. So if the cash budget indicates a potential shortfall, the company can then maybe apply for loans to be able to cover their obligations they have coming up. If it has extra money, then they can plan on what they're going to do with that extra money. So when we're preparing a cash budget, we're going to add budgeted cash receipts to the beginning cash balance, and we're going to deduct budgeted cash disbursements. If our initial cash balance is too low, we might have to look for additional cash requirements, and that's going to have to be added into the budget as we have planned increases from our short-term loans. If our cash exceeds the balance, then we might want to use that money to repay loans if we have any, or even to acquire short-term investments, so that we're not letting that cash sit there and not be used efficiently. Information for preparing the cash budget is mainly taken from the operating and capital expenditures budget. When we're preparing the cash budget, typically we require the preparation of other supporting schedules. We're going to show some of those. So we've got a schedule of cash receipts from sales, and then we're going to be able to look at the next ones. All right, so here it says that TSC has 40% of sales that are cash. The remaining 6% are credit sales that are collected in full the month following the sale. So that's when we know we have to think about, it's 60% of credit sales. What happens if they're not collected? So how are they expected to be collected the following month? We have to plan for those kind of things. All right, so we have a budgeted cash receipts from sales here for TSC. All right, so we have our sales that we prepared before. We also are going to be looking at our ending accounts receivable. So the accounts receivable balance at the end of each month is 60% of that month's budgeted sales. Remember, cash sales are 40% of the month's sales. So our accounts receivable balance at the end of the month is collected in full during the next month. We have to remember that. Cash sales are added to accounts receivable collections to get total cash receipts for the month. And now we can compute the budgeted cash receipts from customers. October's budgeted cash receipts consisted of $24,000 from expected cash sales, which is $60,000 times 40%, plus the anticipated collection of $25,200 of accounts receivable that was actually from September. All right, let's look at our cash payments next. All right, so it says for TSC, they purchase materials entirely on account, and we make full payment the following month for purchases. So we have to know, managers have to know how they're purchasing their direct materials and how fast they're paying for those credit purchases. It's important to be able to know that. All right, so cash payments for materials. Alright, so remember, the balance from the previous month is what we're paying the next month. So if we make full payment during that next month, we have to factor that in. So we have a direct materials budget, and the budget for TSC the plan is to purchase $10,240 of materials in October. But those purchases aren't going to be paid for this month. Instead, the material costs end up in the November column. We then add the balance owed from the previous month's purchases, which was September, out of $7,060. So total cash payments for direct materials in October is $7,060. Alright, preparing the cash budget. Remember that we've done these all in a specific order, so now we're ready to do the cash budget. The fixed overhead assigned to depreciation in the factory overhead budget does not require a cash payment, therefore it's not included in the cash budget. Other types of fixed overhead, such as payments for property taxes and insurance, are included if they require cash payments. When we're preparing a cash budget, we're going to add expected cash receipts to the beginning cash balance and deduct expected cash payments. If the expected cash balance is inadequate, additional cash requirements are going to appear in our budget as we plan increase from that short-term loan we may have to get. If we have excess cash, then we're going to try to repay loans first, and then we would reinvest in short-term investments. Some additional events that affect our Toronto Stick Company is that cash is, for what we see here, so September 30th has a cash balance of $20,000, and we will pay a cash dividend of $3,000 in November. So we might have to make a few notes to refer back to, and you have to remember that when you're looking, you have to incorporate all different parts when you're getting ready to do the final cash budget. Alright, so they give us some information here. Income tax payable of $20,000 from the beginning balance. We're going to purchase $25,000 in equipment. We have an agreement for a bank loan if we need to establish a minimum cash balance of $20,000. We pay interest each month equal to 1% of the prior month's ending loan balance. We repay loans when our cash balance exceeds $20,000. We currently owe $10,000 on a loan arrangement as of September 30th. We have a 40% tax income rate, and we will pay taxes for the current quarter next year. Alright, so again, smaller slide. If you open up the full PowerPoint, you'll be able to see the slides in a little more detail. But now we can see what the cash budget is, what comes from our cash receipts budget, and what goes into, and now we can look at our cash payments next. So our cash payments, we're going to be able to factor in everything that all the scenarios it gave us. So that shows here that we have the income taxes of $20,000 that were due at the end of September, payable in October. We subtracted the expected cash payments for direct materials, labor, overhead, selling, and general administrative expenses. So now we can use some of the additional information affecting cash. So let's look at our next slide. Alright, so we can see that we have a $10,000 loan and we pay interest at the rate of 1% per month. So October's interest is $100. We have a dividend payment of $3,000 that we're planning to pay in November. They have an agreement with a bank for if we go below the minimum $20,000 cash balance, we get a loan. If it exceeds it, then we repay that loan. Based on the cash budget for the month of October, the preliminary cash balance increases to $25,635. So that's more than $20,000. So we will pay off $56,35 of the outstanding loan with that. Alright, for November, we expect to pay interest of $44 because we have the outstanding loan. It's 1% of the $43.65 loan balance as of October 31st. No interest is budgeted for December because we expect to be able to repay the loans at the end of November. If we look here, before our budget is complete, it says they plan to pay $25,000 in December to purchase new equipment. So our ending cash balance in December will be $44,706. All right. In our next section, we'll look at preparing budgeted financial statements.